What's up, everybody? Josh from Red Short Trades here. I am going to go over a trade review of a trade I took the other day on the QQQ. It was a perfect example of the levels that I draw out on all my charts and ultimately waiting for price action to materialize around those key levels. It's so important that we don't just jump into a trade, chasing the trade the minute we see momentum start to blitz in one direction or the other. Always wait for the retest. I think as a break and retest trader, not a breakout trader, that's the one thing that I always try and keep in mind. It's got to retest around a key level in order for me to have confidence in the trade, the highest risk to reward, to be able to manage risk appropriately. So this one just so happened to work out beautifully. So let's jump into the chart and I'll walk you through what I was thinking and the levels that ultimately caused me to take the trade. So here we are on the QQQ chart. This was the other day on the 15th, and this was just a beautiful example of some great momentum right off a key level and a continued flush down that just went beautifully. Did not catch the whole trade, but it definitely was one that you could have if you wanted to play that. So ultimately what I'm looking to do is I start off by marking out my prior day high, which would be up here, my prior day low, and then we had our higher time frame level. So ultimately what we're looking for now, and then I mark out my 5-minute opening high and opening low. So we had our 5-minute candle, opening high, opening low marked out. We had our pre-market level marked out and our prior day level, which I usually signify by purple, marked out. And so what I'm looking for is to use these as potential entry points based on what price action is doing around these levels, or I'm looking to use these as potential take profits points based off, just to give myself very clear risk to reward parameters. So the first one I always look for a break and retest of is my 5-minute level. Now what you saw here was you saw it kind of consolidating for probably the first 35 minutes or so. And we saw an aggressive flush down, broke right past the 5-minute level, and I effectively was waiting for a retest of this level, but the momentum was pretty strong, and intraday you did not see that take place. So what we did start to see was it break below this pre-market level. We saw it immediately wick back into it. Now I'm going to pause here. This is really important because my old self would typically have taken this as a rejection opportunity to move to the downside. And to be clear, there are cases where it does end up doing just that. You have a break through a key level with an aggressive move, and an immediate retest, just like you have here, could serve to be a entry point. But what I find gives you the higher confidence in the trade and a higher risk reward is when you have some sufficient displacement through down, even further displacement from the level, and giving yourself some room to come back and retest. It exhausts buyers and sellers in any particular direction. The other thing that you have to think about with that is you had an aggressive move down here, an immediate retest. There hasn't been a full retracement or any buyer exhaustion yet. Or seller exhaustion yet to be able to show that things are moving. So this could easily have had a ton of buyers step in, even though we wicked here. This was the start. It's an indecision candle. It's a doji candle as well. This easily could have kicked buyers into gear, and this could have reversed pretty quickly back up to that 5-minute level. And that was ultimately what I was waiting for, was that retest. It didn't get there though. It just kind of hovered here and consolidated. So ultimately what I was looking for was a little more displacement, which we ended up getting this big candle shooting down here. Now, to be clear, this also is sometimes a good indicator that, okay, you got to hop in the trade. The momentum is continuing. But what I have found more often than not is I actually don't typically like to play the bullish or bearish engulfing candles. And the primary reason why is by the time you end up jumping into these candles, you're so far away from your stop loss that if it does end up reversing, your loss is just going to be a lot higher. And so more often than not, what I will do is I will pause. I'll either miss the trade, or what I'll try and do is I'll wait for the pushback into the key level again, just like what we got here, and wait for that hammer candle where we have a really nice wick above the level, showing that buyers are trying in, and a pushback below the key level. So we have a close below the level to show that sellers stepped in and are closing the candle strong. This gives me a much higher risk to reward because it's so close to my stop loss. Notice too, my stop loss here is just a break above this particular high. The last high is a break of market structure. If it breaks this, it potentially is going to reverse back up Don't want to do that. So that is where our stop loss is set. And the other thing I saw on this particular trade is this guy right here. We saw this really nice bear flag forming. And so there were a few things that made this really high probability. We had this aggressive move down. We had this bear flag forming, sufficient displacement from one of the levels that I typically use for entry, which is a pre-market level. We had some displacement, retrace in, wick above. That's another parameter that I look for. A close below serves as the entry. Highest risk to reward here. And then where am I looking for my profit targets? Well, I already have them marked out. And this gets to such a key thing. Go into your trade with the plan. Plan your trade, trade your plan. And so it's important to have the levels of that you would take already marked out, so you're not trying to figure out where you're going to enter and exit. And so my profit target here, which ended up giving me a 3.68 risk to reward ratio, was effectively my prior day level. So I ended up getting out there, saving a trailer for this 495 level, which was I had marked out on my higher time frame. It blitzed right through this and started going all the way down. So we didn't catch the full move, but I don't want to use this to show how you catch a full move. I want to show this to show you how I use these levels and trust these levels to ultimately take my entries and my exits and put them on higher time frame levels. So this is a great example of the break and retest. I'm a break and retest trader, not a breakout trader. I don't trust myself enough for that. But the break and retest is where you get the highest risk to reward, in my opinion. And this is a great example of a aggressive push down around the key level price action, around the pre-market level, a beautiful bear flag, great entry point, and then an aggressive push in continuation because we are playing continuation momentum. And there you have it, the break and retest strategy. Again, marking out some key levels, the 5-minute level, the pre-market level, and the prior day level, along with some higher time frame levels to ultimately give you strong entry and exit points. I hope this was helpful. If it was, definitely drop a like. Pound that subscribe button so you get more content from me here. And if you have any commentary too about things that you've seen really work effectively, I'm continuing to learn this, trying to keep the strategy simple as I possibly can, not trying to noisy up the charts with a bunch of indicators and things like that. So if you have any things that you found work, please drop them in the comments. Love to engage in the comments below. Otherwise, until next time, we'll talk to you then.